UK inflation, which gauges the rate of price increases, decreased from 10.4% in February to 10.1% in March. That's year on year. It was widely anticipated that it would drop below 10%, but despite climbing at their quickest rate in 45 years, food prices remain stubbornly high. The rate at which prices are rising is slowing down, not necessarily that prices are, of course, declining. For more of these headlines, cross over to London. We're joined by Rise business analyst Bode Ososanmi. Good morning, Bode. Thanks for joining us. What are your thoughts on the Netflix results?
Yes, good morning, Rotus, and thanks for having me on the show. Well, Netflix missed on subscribers' targets and the outlook was weak, but it was a beat for earnings, fell short of Wall Street estimates for revenue. They also said to be pushing back the full rollout of their password sharing crackdown model, which was originally planned for the first quarter in the US. The streaming giant was still able to generate more cash as subscriber growth slowed dramatically by cutting content costs. Netflix actually cut its content spending by more than $1 billion during the first quarter compared to the previous year, so they were able to generate more cash because of that cut. But what analysts are focusing on really is the outlook for the June quarter. Netflix said it saw revenue of $8.24 billion, up 3.4%, with profits of $2.84 a share. That's for the June quarter. That comes below Wall Street estimates of about $8.5 billion and $3.07 a share. Also on ads, they say paid net ads in the quarter should be roughly similar to what it saw in Q1, which again is below previous estimates. And they see second quarter operating income of $1.6 billion, with operating margin declining slightly to 19% from 20%. However, they say their financial challenge objectives are unchanged, and they still believe they can see double-digit revenue growth while expanding their margins. The content spending, I think, is where we expect things to be flat, if not down, as a way of managing the books. But they also boosted their financial standing to compensate for the bad news, buying back 1.2 million shares in the quarter for $400 million, adding that they intend to accelerate more buybacks over the course of 2023. As you know, buying buybacks shows you have a balance sheet strength that you can still use to enhance your positioning, especially as per your shares. But Netflix also said we're pleased with the results of launching paid sharing in Q1 in Canada, New Zealand, Portugal, and Spain, adding that the subscription base in Canada increased as a result of implementing paid sharing. So we'll see what happens in Q2 when they implement this paid sharing in the US.
United Airlines also announcing its results. What are we learning on the aviation sector?
Well, this is a sector that, if you look at how they've been performing, the thinking was that they're going to bounce back very strong in 2023. Although I can see that UAL, their shares were up 1.56% as at yesterday. If you look at how they're performing, pre-markets also up 1.02%. It was a surprise to analysts last month when it was forecasted by them. They had a profit warning that they were going to see a loss ranging from between 60 cents and $1 per share in the first quarter, citing higher jet fuel prices, capacity growth issues, lower demand in January and February. Analysts were expecting a profit of 66 cents per share. So after that profit warning, there was a slump of about 12% in their shares in just 2 days. But now they've announced loss per share of 63 cents, which beats expectations for a loss of 73 cents a share, and revenue of $11.43 billion, slightly ahead of expected revenues of $11.42 billion. I think they've managed expectations in a way that they're looking somewhat up. As the news broke, their shares gained 1.8%. I can see it's also slightly positive in pre-market. So we'll see what happens when the stock exchange fully opens. CEO Scott Kirby, he said the airline is watching the macroeconomic risks carefully, but demand remains strong, especially internationally, where we are where we are seeing growth at twice the domestic rate, according to Kirby. Total operating revenue in quarter one increased by 51.1% compared with the first quarter of 2022, and revenue per seat mile also rose 22.5%. Capacity grew 23.4% in the first quarter compared with 2022. Of course, the major headwind to the comeback of airlines continues to be energy costs. And we also have to accept that with high inflation, the discretionary spend is under pressure and wallets are still under pressure. So we may not see that immediate bounce back. Although a lot of the savings made from COVID years, many say they have now been spent or they're still to be spent, leaving some room. My sense is, based on the data, Q1 was come see, come sir for the airline sector, and players are cautious to manage expectations given the uncertainty in the macroeconomic risks, especially on consumer sentiment, even though there's strong consensus that 2023 has to be better and airlines should be a buy given the trends.
All right, UK inflation still remaining in double digits. What do you make of the release?
Yes, indeed. We thought they would slip down into single digits, but not so. The Independent Office for Budget Responsibility is also predicting that inflation will halve this year, just like the Tories are praying it will. Chancellor Jeremy Hunt had also reacted to the figures that came out today, that it reaffirms why they must continue with efforts to drive down inflation to ease pressure on families and businesses, also saying that the UK is on track to do this. But if you look at double digits in March, 10.1%, above projections of 9.8, but it would have been good to just go under 10. But that didn't happen. And we saw that huge jump in February to 10.4, which disrupted a trend of 3 consecutive months of decline since October's 41-year high of 11.1. So some are saying, are we now resuming the decline, or is inflation still looking sticky? Monthly CPI is something that one should really pay attention to. It was 0.8%, also above consensus, but down from the 1.1% of February. According to statistics, the office, the largest downward contributions to change in inflation came from motor fuels and housing and household services, particularly liquid fuels. But this was partially offset by upward contributions from food and recreation and culture. Food and non-alcoholic drink prices also remain a very key driver of inflation, rising by 19.2% in the year to March. The core CPI, that's excluding energy, food, alcohol, and tobacco, rose by 5.7% in the 12 months to March 2023. My sense is, yes, we got CPI today. We had UK unemployment data yesterday inching up to 3.8% in the 3 months to the end of February, even as economic activity levels continue to fall. The Bank of England has to consider, as they now decide in May, the softening in the tightness of the jobs market, particularly in the continued fall in vacancies, and decide if pay growth is moderating down enough towards rates consistent with the BOE targets. But many believe that this release that we saw today confirms the narrative that inflation remains sticky. Last month, they hiked interest rates by 25 basis points to 4.25. The thinking now is that this reinforces the fact that they'll probably do another hike. And no surprises, FTSE 100 was down, snapping an 8-day rally as consumer prices fell less than expected. And of course, this was because it boosted bets for one more quarter point hike, at least one more from the Bank of England when they meet in May.
All right, we'll see how things turn out. Arise business analyst Bode Ososanmi, thanks for taking us through the headlines. Appreciate your insights as always.